Hello and welcome to another episode of Insurance in Canada. I'm your host, Rick Pineda. Thank you so much for joining me. On today's episode, we are looking at three articles. The first article looks at potential insurance implications for those people involved in the gig economy. Second article, we look at the bylaws coverage. How much do you know about it? What sort of coverage gaps could there be potentially in bylaws coverage? And our last article looks at Alberta truckers, what kind of insurance future is in store for you. So without further ado, let's take a look at insurance in the news. Our first article today looks at some of the risks that people who are involved in the gig economy doing side hustles uh, face when it comes to not only issues with the Canada Revenue Agency, but insurance issues as well. So our first article, Side Hustles, Hidden Risks, Why Canada's Gig Workers Challenge Traditional Property and Casualty Insurance, is what PNC stands for. The gig economy is reshaping how Canadians work as more people take on side hustles without fully understanding their obligations to the CRA, according to a new survey commissioned by H&R Block Canada. I'm going to skip most of the tax implications because this is an insurance channel, so I'd rather focus on that as opposed to the tax implications. For insurers, the findings point to a fast-growing, often underinsured customer segment whose work patterns, income sources, and risk profiles not fit neatly in traditional personal or commercial lines. From an insurance perspective, many gig workers are effectively running small businesses through personal policies that were never designed for that exposure. The same cohort that is willing to take tax risk is frequently operating in gray areas of coverage. In personal auto standard policies in Canada often exclude carrying passengers or goods for a fee unless a specific rideshare or delivery endorsement is added, and that is true. Keep in mind with the rideshare apps like Uber and Lyft, they do have their own special fleet policy that takes over coverage when the driver who is operating for one of those two companies is operating with the app and carrying passengers. When it comes to delivery, food delivery, any sorts of delivery, I know that Uber Eats has coverage for their drivers when they are delivering for Uber Eats. The other two popular apps, Skips the Dishes, and the other one, can't think of offhand, coverage is very limited or non-existent. Now, when it comes to ride sharing, your own personal insurance company that insures your vehicle, most insurance companies don't have a big issue when it comes to using your vehicle for Uber or Lyft. Most will allow it, but it's going to vary from insurance company to insurance company. When it comes to delivery, though, no. There is, except for one insurance company, and that's Economical Insurance, Economical/Definity Insurance. No other insurance company is going to want to stay on risk if they find out you are using your vehicle for delivery. And the only reason Economical does that, Economical/Definity does that, is because they are the ones who insure Uber and Uber Eats. So as long as you're using your vehicle, as long as you're only operating with Uber Eats, then that particular insurance company is okay with you doing that. However, speak with your broker or agent to get the details about that coverage. But like I said, the other insurance companies, no. The other personal insurance companies are not going to want to stay on risk if you get into an accident while you are delivering, and if you get into an accident, that is grounds for coverage denial for failure to inform of material change in risk. So yeah, Uber and Lyft probably carries less risk than Uber Eats, Skip the Dishes, and like I said, I can't remember the third one, but I'm sure someone will remind me, yelling at the screen right now and probably rushing down to the comments to write down. So use those apps as a delivery person, rideshare person at your own risk. Know what is provided in terms of coverage from the app provider and speak with your broker or agent before undertaking any of these activities to let them know that you are going to be using it for one of those apps and what the implications are for your coverage or for the company to stay on risk. Some insurers will decline or non-renew risks that regularly use a vehicle for app-based work. Dedicated commercial or hybrid products are available in some provinces for rideshare and delivery. And when I speak about the coverage for Uber, Lyft, Uber Eats, Skip the Dishes, I'm talking about Ontario. Other provinces, Uber, Lyft, Uber Eats, have separate policies in most other provinces in Canada. So people who are driving for Uber and Lyft do have coverage in their own individual province. But as I said before, when it comes to using delivery apps, it's going to be difficult to find an insurance company who's going to provide coverage. I can't speak for those provinces that have government-run auto insurance like BC, Manitoba, or Saskatchewan. I haven't seen what those particular insurance companies what their tolerance is for people who are using the vehicle for those purposes, or what product they've developed in order to provide coverage. But private insurance provinces like Ontario, like Alberta, the maritime provinces, yeah, it's going to be a bit of a different story because private insurance companies balk at any sort of private passenger vehicle being used for delivery. Excuse me. Dedicated commercial hybrid products are available in some provinces for rideshare and delivery drivers, but awareness and take-up vary, leading to disputes when claims arise. Similar questions are emerging in home and liability coverage as more people use their homes as workplaces, storage hub, or short-term rentals, or monetize digital services from home. Existing wordings may not fully capture exposures related to third-party injury, property damage, data breaches, or business interruption tied to side hustles. Yeah, if you're putting your residence, or there's your principal residence, income residence up for rent on apps like Airbnb or Verbo, once again, speak to your broker or agent to discuss coverage issues when it comes to utilizing those apps. Some insurance companies will allow you to rent out your premises, whether it's your primary or rental premises, on short-term basis, but not every insurance company does. Some you might have to add an endorsement. Some it's already in the wordings, but better safe than sorry. There are other apps. I can't remember the name of the app where you can rent out your swimming pool. Yeah, you better speak to your insurance company before doing that. More than likely, the insurance company won't want to stay on risk if you're doing something like that. They're renting out an entire premises is one thing, and renting out something risky like the swimming pool is a different story altogether. So before entertaining that idea, before even looking into the app, speak with your broker or agent to discuss the coverage implications. Existing wordings may not fully capture exposure related to third-party injury, property damage. For carriers and brokers, the survey results underline the need for clear disclosures at point of sale, more targeted questions on applications and renewals, and product development that can flex with multiple income streams and variable hours. The survey highlighted a clear generational divide in attitudes towards tax compliance. Over 1/3 of gig workers say they would be willing to take the risk of not declaring any gig-related income to the CRA when filing their taxes. Among gig workers aged 18 to 34, that figure rose to 41%. And for insurers, the same lack of clarity is mirrored in coverage. Younger gig workers may not fully understand when a personal policy stops responding because an activity is deemed commercial, or what kind of riders, endorsements, or separate policies they need to protect income, assets, and liability tied to their side work. Anything else related to the insurance side? Yeah, the rest seems to be the tax implications. So Bottom line, before considering undertaking any of these side hustles, taking part in the gig economy, uh, consider your insurance coverage, because if something does happen, uh, being a delivery driver puts you at risk of being sued if the product uh, does injure somebody. If somebody gets sick for delivering food, stuff like that. Being in the chain from the manufacturer to the time the product is received by the end user, you're still in that chain and still liable to be sued by the injured party. I can't think of any court cases offhand that occurred, but retail outlets always face this risk when it comes to products that they sell that they don't actually manufacture, that they're actually resellers. So once again, just because you're using the app from a large corporation doesn't necessarily mean you're going to be provided coverage should something like that occur. So once again, speak to your broker or agent before entertaining the idea of using I'm not discouraging you from not using these apps. Just do your due diligence and make sure that coverage is provided somewhere for you to not have any gaps in coverage. Our next article looks at bylaws coverage. If you're not familiar with bylaws coverage, on a property insurance policy, say your homeowner's policy, depending on what kind of basis of claim settlement you have, whether it's actual cash value or replacement cost, the insurance company, if we have replacement cost, will pay should something happen to your residence and the entire residence is destroyed to rebuild the house or rebuild other damaged property if it's other property that's damaged. However, there are certain exclusions. So any additional, and one of those exclusions is a very common exclusion, any additional costs in order to comply with a bylaw is not covered under the policy, the homeowner's policy, even a commercial property policy. That's a standard exclusion. For instance, I had a client who had a house in Toronto who had a detached garage in the backyard. There was a laneway in the back. That's how you access the garage. So it was a detached garage, and all the neighbors, in the same situation, had their detached garage in the laneway as well. One night, an arsonist came and set fire to a bunch of the garages, and unfortunately, our client was not spared from that. Most of the garage, but it was partial loss, however, was damaged enough that it was considered a total loss. So the garage would have to be rebuilt. However, the cement pad itself was not damaged. However, the bylaws enforcement officer for the city of Toronto came by as the debris was being removed and informed the homeowner that the cement pad, the thickness of the cement pad no longer met current bylaws. It was too thin. So the cement pad would have to be torn out and re-poured to the correct depth to meet current bylaws. The cost to tear out the cement pad and re-poured would not have been covered because the cement pad was not damaged in the fire. This was an additional cost in order to comply with current bylaws. Bylaws coverage can be added to a property policy, homeowner's policy, commercial policy, in order to cover those costs, those additional costs. Some insurance companies add that as a convenience coverage. For most commercial policies, you usually see that included as well. On homeowners policy, most insurance companies, you can add that coverage by an endorsement to your policy, and it will cover up to a certain amount. Some insurance companies, it's as low as $10,000. Some insurance companies goes up to 100,000, and some insurance companies include it in the limit of the policy itself. So it's a very important coverage to have on your homeowner's policy. Definitely not something you want to skimp out of, because you never know who keeps up. Your average person is not going to keep up with changes to building codes and local building bylaws. Some people's job it is obviously do, but for the rest of us, who's going to keep track of that and know if something were to happen to your house, what changes have to be done in order to comply with local bylaws. So that's what this article is focusing on. Do your clients understand bylaws coverage gaps? A rare decision by Canada's Supreme Court to review a civil case in 2024 highlights a key coverage point brokers can use in conversations with clients. The case, Trillium Mutual Insurance versus Emond, centered around a couple whose home on the Ottawa River was destroyed and later sued when their insurer deemed the policy's guaranteed replacement cost endorsement did not cover the costs to meet regulatory standards or bylaw changes enacted since the home was built. So I talked about replacement cost as a basis of claim settlements. Those replacement costs are actual cash value. Actual cash value is the cost to replace minus the depreciation for that lost property. With replacement costs, the insurance company pays to replace the lost property up to the limits on the policy. With guaranteed replacement cost, even if the cost to rebuild your house is going to cost more than the building limit on your policy, the insurance company with guaranteed replacement costs will pay whatever it costs in order to rebuild your house. It's another important endorsement, and it's something you definitely want because, we can estimate what the replacement value of a particular house might be, but there's no way to guarantee for certain that what our estimators come up with is the correct value. So with something like guaranteed replacement cost on your policy, that is a huge safety net in case that the amount being insured for turns out to be underinsured, especially when you take into account inflation these days. It's not that difficult for one to be underinsured. But guaranteed replacement cost, that's something you see on homeowners policy. You don't see that really on the commercial line side. That's something you see on homeowners policy and you definitely want on your homeowners policy. So, but keep in mind, even with guaranteed replacement cost, it's still subject to the exclusions on the policy, and one of those exclusions is the bylaws exclusion. So like I said, company will pay to rebuild your house regardless of how much it actually costs to rebuild. However, those costs that are incurred to now conform with building codes, bylaws, still will not be covered unless you have the bylaws endorsement. Back to the article. While lower courts initially found for the couple, the Supreme Court determined that policy did not entitle the family to these additional rebuilding costs in the February 2026 decision. GRC, guaranteed replacement cost endorsements, generally apply to homes that are destroyed by catastrophic events such as flood or fire. Well, basically anything that's covered or not excluded by the policy. While most policies include replacement cost coverage, extra building costs required to meet current building codes or safety standards are often capped under separate bylaw coverage, leaving homeowners exposed. He being Daniel Ivins, who provides commentary for rate aggregator rates.ca. He lists some gaps in bylaws coverage that homeowners might not be aware of or don't fully understand. Bylaw coverage does not equal replacement cost, correct? Replacement cost generally covers the rebuilding of a home to the state it was before the loss. By contrast, bylaw coverage is used when further upgrades are required to ensure the rebuilt home meets building code changes and new zoning rules or safety regulations enacted since the home's construction. When a bylaw coverage is included automatically, often comes with a preset limit, but those default limits might not be reflective of current costs to rebuild and could fall short when current regulations and rebuilding requirements are taken into account. Limit adjustments are not automatic even when local rules or standards have changed over time. Bylaw coverage limits typically remain the same unless they are reviewed and updated. And depending on what the limits available from your insurance company is as well, if the most that your insurance company is willing to offer is $30,000, there's really not much else you can do besides trying to find another insurance company that would be willing to offer higher bylaw limits if that's a concern for you. Homeowners will be on the hook for any costs exceeding the limits in the bylaw policy. So the difference between the policy limit and the excess cost due to regulatory upgrades become the homeowner's responsibility, which is very true. And don't underestimate how much these additional costs to comply with local bylaws and local building codes could actually add to the rebuilding cost of a structure. Rebuilding after a total loss isn't about restoring what was there before, it's about meeting today's standards. That's when bylaw limits tend to show up as an issue because the rules and requirements at the time of a rebuild may be very different from when the policy was first set up or fully understood, which is very true. So bylaws coverage, take a look at your homeowner's policy, take a look at your commercial policy, commercial property policy, have a look to see if you can find bylaws coverage, take a look at what the limits are. If you can't find it or are unsure, speak to your broker or agent and inquire if your policy has that. Now, you wouldn't need it for a tenant's policy because the tenant doesn't own the building, so they're not concerned with replacing the building because it's a landlord's responsibility. Even a condo unit owner's policy does not require bylaws coverage because it's the condo corporation that insures the structure itself. So the condo corporation should definitely have that coverage on their policy, but the individual unit owner's policy wouldn't require that. But for all the homeowners out there, yeah, if you're unsure, speak to your broker or agent and confirm with them whether your policy has it and what kind of limit you have, and consider increasing that limit as well, because yeah, those additional costs aren't getting any lower, that's for sure, what costs are these days. Our last article looks at Alberta truckers and insurance, what insurance costs look like for you in the future, which I can't imagine is any better than in any of the provinces for that matter, considering how much of an issue it comes to trucks getting into accidents these days. But Alberta truckers insured by the Facility Association face steep rate increases. Sorry, folks. Sorry, Albertans. Wish I had better news for you, especially considering our last episode spoke about issues regarding insurance for Alberta motorcyclists. Now it's the truckers who are getting dinged. Ranks of insurer of last resort swell with Alberta trucking fleets. Now, it says the Facility Association. The Facility Association is an organization. All auto insurers in that particular province are members of the Facility Association. And yeah, as it says, they are the insurer of last resort. So even if you've been refused by every other insurance company in the province, the Facility Association, as long as you have a valid driver's license and legally own the vehicle, will accept you. You may not like the rates that they're going to charge, but they will accept you. So that's why they're known as the insurer of last resort. So if you're going to Facility Association, there's usually a reason for that, and it's usually not a good one. So, but the Facility Association insures pretty much anything that's legally required to be insured: private passenger vehicles, recreational vehicles, motorcycles, and commercial vehicles as well, from, simple pickup trucks being used for artisan use all the way to tractor trailers and large commercial vehicles that require to be licensed and insured. Alberta trucking fleets insured through the industry's insurer of last resort are facing a steep rate increase that reflects deeper challenges in the province's commercial auto insurance system. The Facility Association, the residual market that provides insurance for high-risk or hard-to-place operators, is implementing a 28.23% rate increase for interurban vehicles in Alberta. That change takes effect March 1st, 2026 for new policies and April 1st for renewals. That is a substantial increase year over year. Keep in mind, not every truck in Alberta is going to be insured with the Facility Association. And keep in mind, the Facility Association operates in every province that has private insurance schemes. So you won't find a Facility Association in BC, Manitoba, or Saskatchewan because they have the government-run insurance companies. who will accept every vehicle regardless of how bad a driver you are. So they have no need for the facility association, but the facility association operates in Alberta, they operate in Ontario, the maritime provinces are also, they operate as in there as well. So, and they operate the same way, insure of last resort for anything from private passenger vehicles, commercial vehicles, recreational vehicles, RVs, etc. So interurban vehicles generally include long-haul and regional trucking operations traveling between municipalities. The increase highlights the financial pressures affecting Alberta's commercial auto insurance market. But as I was about to say, not every truck is insured with the Facility Association. Obviously, you'd want to be insured with a standard market that's going to be providing better rates, better coverages than what the Facility Association is willing to insure. However, if the standard market will not insure you, it's going to be the Facility Association is going to be your only choice for coverage. Alberta has been the epicenter of Facility Association's commercial vehicle growth for nearly a decade, said Samuel Elkins, founder and executive chairman of Strategic HSE Systems. According to data from the Alberta Insurance Rate Board, the residual market now represents 10.3% of province's commercial auto insurance market, up from 3.9% in 2017. That's a huge increase. But it's not that big a surprise considering the tightening of the automobile insurance market, not only in Alberta, but other provinces that have private insurance schemes. So to see that big a rejection when it comes to the standard market, when it comes to commercial automobiles, not a huge surprise if you're in the industry itself. That's concerning for what's supposed to be the insurer of last resort, Elkins told CU's companion outlet trucknews.com. Facility Association does not operate like a traditional insurer. Instead, it functions as a statutory insurance pool made up of every company licensed to write automobile insurance in the province. When a driver or fleet cannot obtain coverage in the voluntary market, their policy is placed through the Facility Association. Now, keep in mind, it works a little differently for private passenger vehicles. For private passenger vehicles, there are non-standard markets who may be willing to insure your vehicle if the standard market rejects you. Most of the time, they offer better rates than what the Facility Association offers, but that's for private passenger vehicles. Commercial vehicles, no. You're either standard or you're going to facility. Premiums, losses, and expenses are pooled and shared amongst the insurers based on the market share. If an insurer writes 10% of the auto insurance market in Alberta, they absorb 10% of the Facility Association's result, whether they want to or not. Policies are administered by servicing carriers in Western Canada, Ontario, and Atlantic. These policies are currently handled by Nordic Insurance, a subsidiary of Intact Financial. So while the Facility Association does have its own building, they do operate, however, it's actually Nordic Insurance, which is a company that belongs to Intact Insurance. They're the ones who actually issue the policies and handle claims on behalf of the Facility Association. So, that, as it says, Ontario, Atlantic Canada, Western Canada, if you're insured with the Facility Association, you'll see your policy says Nordic Insurance operating on behalf of the Facility Association. But insurers do not voluntarily choose to insure these risks. The short answer on incentive is there is none. Facility Association exists because mandatory auto insurance requires a backstop. Several factors have combined to make Alberta one of the most challenging commercial auto insurance markets in Canada. The province operates under a tort-based legal system that allows injured parties to pursue lawsuits with no cap on non-minor injuries. But of course, we know that's going to be changing on January 1st of 2027 with the new Care First model coming in and restrictions on trying to sue for injuries you suffer in an automobile accident in Alberta. That tends to produce larger settlements and longer claim timelines and systems with stronger no-fault components. At the same time, insurers have been losing money in the province. The Insurance Bureau of Canada reports Alberta auto insurance lost $1.2 billion in 2024, paying out roughly 18% more in claims than they collected in premiums. And we've seen insurance companies leave the province of Alberta because of the unsustainability of trying to do business in Alberta. Aviva Direct, Sonnet Insurance have left the province of Alberta. There was a third insurer whose name escapes me at the moment. So there is a point where insurance companies just throw up their hands and say, we're out of here. Yeah, it costs money to set up shop in a particular province, but if you're just throwing good money after bad, there's no point in just maintaining the office for the sake of trying to justify your startup costs. But the province has been trying to find solutions, working with the auto insurance industry to try and convince insurance companies not to leave, to stay. Unfortunately, it hasn't quite worked out yet. Any changes you do to any sort of insurance product, it takes years in order to see the ramifications in terms of how it affects claims costs. So we'll see. And the upcoming changes on January 1st, 2027 to accident benefits is one of those changes. So unfortunately, it'll be a few years before we see the ramifications of those changes as well. Commercial trucking claims have also climbed sharply between 2017 and 22. Claims cost nearly doubled, rising from about 150 million to 274 million. The voluntary market has retreated. 3 carriers have exited the province entirely. Drivers' training standards have also been part of the discussion. Alberta's previously mandatory entry-level training, or MELT program, required roughly 120 hours of instruction for new commercial drivers, significantly less than programs in provinces such as Quebec. The province replaced MELT in April 2025 with a new Class 1 learning pathway aimed at improving driver preparedness, but insurance claims often take years to fully develop and impact claims. Trucking companies ended up in the Facility Association when insurers are unwilling to offer coverage in the standard market. Common reasons include poor claims histories, and for something like commercial vehicles, that's probably the biggest reason for denying coverage from the standard market is the claims history. Incomplete driver qualification records, weak safety management systems, or a lack of insurance history for new carriers, but fleets are not necessarily stuck there permanently. Roy Cragen, president of Transcom Fleet Services, said companies can earn their way out of the residual market just as they earn their way in, but it requires major changes. The earn facility, I'm not sure if earn's the best way to describe it, but sure. The owners and managers have accepted the fact that they did this to their company, and what they need is an intervention. He said there is no quick fix for fleets trying to escape the pool. They need wholesale change. There's no magic bullet to go from facility back to the regular insurance market. Cragen said one company he worked with was facing the loss of its operating authority due to safety and compliance problems. After restructuring its operations and improving safety performance, the fleet dramatically improved its regulatory audit score and eventually was able to return to the voluntary insurance market. In about 12 months, their insurance dropped by tens of thousands of dollars and they got back with a commercial insurer. But that level of turnaround requires rebuilding how the company operates. You have to restructure the whole business. You have to redo the safety programs and change how the company is managed. For carriers hoping to return to the voluntary insurance market, safety and documentation remain critical. That includes maintaining complete driver qualification files, implementing active safety management systems, and demonstrating improvements in claims performance. And for any carrier, anyone who works for any of these carriers, this is something you do now. You don't wait until the claim situation has gotten out of hand that the insurance company is now looking to boot you from them into the Facility Association. This is something you need to look at right now, especially when it comes to new drivers, driver safety programs, continued training. All that has to be done now. Because if you wait until it's too late, you're going to be paying through the nose to stay in business trying to insure your fleet. So unfortunately, for a lot of people, it usually requires them to learn the hard way that irresponsibility does carry penalties. But like I said, for the responsible carriers who have implemented these programs and enforcing them, hopefully they will stay out of the doghouse that is the facility association. And that is it for me for today. Thank you so much for joining me. If you like what I do here, please like and subscribe for more. Please share this video with others who you think might be interested in the information presented today. Make sure to follow Insurance in Canada on Twitter/X. And until next time, bye-bye.